Now that we've determined that we think the market is going up and we've selected the sectors that we want to invest in the stock market, now it's time to pick our stocks. So keep in mind, there are thousands of companies to choose from and we only need 11. So we're going to be very, very picky in this process. There are thousands of ratios, there's tons of information, but I'm going to give you two simple criteria for selecting a stock. The first one is its profit, because it's all about the profits when we buy companies. And the second one is about its personality. Is it a winner? So let's think about this. Let's think about buying a business, because that's exactly what we're doing. Let's say you want to buy a hot dog stand. And let's say you've done a little research and you've found two different hot dog stands. One's on Fifth Avenue, the other's on Water Street. They cost the same, they cost $10,000, and they serve the same kind of dogs. But the one on Fifth Avenue is a little fancier, has more amenities, it has some nice napkins, uniforms for the vendors. So their costs are higher. They're making $250 profit a day. The one on Water, however, lower costs, but because of that, they're making $350 a day. So if we were going to select between these two stands, we would pick the one on Water Street because it's making more profits. But things change, and we need to be aware of the changes in our stocks as well. So on Fifth Avenue, they've decided that since they have a wealthier clientele, they're going to raise the prices of their hot dogs. So now Fifth Avenue is successfully making $500 a day in profit. And so now $500 a day versus $350 a day on Water Street, the Fifth Avenue stand is a better buy. But let's say the guy on Water Street that wants to sell you the stand says, wait a minute, I have another stand. I'm opening it a block away. It's going to raise our costs a little bit, but we know it's going to work, and we know that we're going to make about $600 a day in profits once we put up this stand. So now we have a situation where the Water Street stand is a lot better, because for the same money, you're making more money in profits than you are with the Fifth Avenue stand. And that's how we measure the value of stocks, with the P/E ratio. P/E means the price over the earnings. With the hot dog stands, the price is $10,000, the earnings are $600 for Water Street, $500 for Fifth Avenue. $600 is the better value. So what we want to do is really take a look at this ratio, the P/E ratio, price over earnings. Now realize that usually when we see something with a higher price, we think it has more value. If you're going to buy a new chair, for instance, and it costs $100 versus a chair that costs $10, you would say, no, I want the $100 chair. It's better value. It's more expensive, so it must be better. Not so with stocks. Let's take an example here. We have a stock price of $100 versus a stock price of $10, two different stocks. The $100 stocks has earnings of $10 a share. So you've invested $100, you're getting back $10. Here, you take the earnings, divide them into the stock price, and you have a P/E of 10. The other stock that we have trades at $10 a share, but it's making $2 a share in earnings. The P/E then is 5. Which is more valuable? Well, for the money you're investing, you're getting a better return on the $10 share than you are on the $100 share. So we don't look at the stock price, we look at the P/E ratio, because companies are all about the profit. We use the P/E to compare companies to companies in the same sector, to compare different sectors, where they historically trade to where they're trading right now. And we also use the P/E to compare the company to the market. And if we have a lower P/E, it's typically a better value. Dividends are another way that a company pays out profits. So it's a very important thing to look at. In fact, dividends right now are extremely attractive. At this point, they're tax advantaged, much lower tax rates on them, and the big U.S. companies are paying 2.5% on dividends, which make them a very attractive source of income for retired people. So always consider the dividend as part of the profits, paying 2.5% right now. Now, the other factor that we need to look at with our stock is its personality. You know, businesses evolve over time and they develop a personality. Have you ever known someone who started out of the gate real fast and was all about telling you how wonderful they are, but over the long run, they weren't reliable, they made mistakes? It's all right to make some mistakes, but not a lot of mistakes. They had ethical or moral concerns, issues. The same thing with companies. We need to look at our company and ask ourselves, do we like it? Do we like the products? Do other people like the products? Are there any issues out there? What kind of history has it had? What kind of habits do they have? Do they treat their people well? Do they care about the environment? All of those things matter. And the reason I talk about issues is because issues are something that can hurt a company dramatically. For instance, if you take a tobacco company, there's a problem there. We know very well that it's not healthy. In the long run, we know that that's going to catch up with the company. Remember, there are thousands of stocks that you can pick from. Pick the squeakiest clean companies that you can get. Look for the issues. If they have issues, lawsuits, consumer problems, ethical concern, stay away from that stock, because over the long run, you want the highest quality companies that you can get. You want to pick a portfolio of beautiful, shining gems that are here for the long run that you can put your money into. So we want to watch out for issues, we want to watch out for ethical concern, legal problems, government involvement, just like we do with sectors, and we want to be very, very picky because we want to remember we only need 11. Now, what kind of stocks should we buy? Well, typically, the bigger, the better. Because if a company is bigger, it's considered higher quality. Now, you hear the terms mid-cap, small cap, large cap. What the heck is cap anyway? Cap is capitalization. Capitalization simply means money, assets. So if a company has a lot of assets, reasonable amounts of debt for that particular industry, it's usually considered to be a better company. The other thing good about buying a big company is that it's highly visible. We can get a lot of research on it. We can get a lot of news on it. We can see what's happening to that company every day if it's a very large U.S. company. Right now, we have tremendous value in our large U.S. large cap companies because they're trading at very low PE ratios. So right now we can buy the big cap. If the big caps have already gone up and they've made their move, then we want to enter into the mid caps or the medium-sized companies. Once they've made their moves, we want to enter into the small cap companies. But the research on that has to be much more extensive and is a little bit more difficult because you don't have the visibility. So the next question is, where do we get the information? We said before, information is very, very important. Well, it's sort of obvious. First thing we look at is the paper, right? If we read the paper anymore. There's all kinds of articles that will tell us about the economy. It'll give us ideas. It'll show us, oh, new product here. I think I'll look at that company. You're going to be looking at many, many, many companies before you pick your 11. You really will. And the more you learn about one company, the more you're going to learn about another. So with this information, you are going to look into paper first. Now, very important that you only look at professional publications. Bad information is your enemy. You need complete, up-to-the-minute accurate information. So information that's a week old is absolutely worthless. Stick with the professional publications like the Wall Street Journal, Barron's, Financial Times, Investors Business Daily, the real publications that only do financial news. The other source of information, of course, is the internet. You can look up a company and find out all kinds of things. Here you're looking for issues. Do they have a legal problem out there looming? Don't buy it. Do they have consumer product problems? Don't buy it. Do they have all kinds of things happening and coming out right now? This might be something that you want to look at. The third source of information we have out there is the company itself. If you go on the company's website, every bit of public information available you have access to. You can look at all their quarterly reports. You can look at their annual reports. One great source of information is the Chief Executive Officer's letter to shareholders that is written on an annual basis. And the reason this is a great source of information is that the Chief Executive Officer supposedly knows everything about this company. He is going to tell you everything in that letter that's important, because he is required by law to disclose fully all of the material information. So his letter will tell you if there's a negative issue. It will tell you what they're working on. Let me tell you, if there's a negative issue that is mentioned in this letter, then realize it's usually just the tip of the iceberg, because the Chief Executive Officer is not going to dwell on the problems, but he has to mention them. So look at your financial statements. You say, well, what do I know about financial statements? Look at them. You will be surprised at what they tell you. Tell you how much revenues, how much profits, what they're spending on what, and everything you need to know is right there at your fingertip. It's public information. Now, the other thing that you have access to are research reports. You have lists that the analysts have made for you. You have recommendations out there. And you also have beautiful research reports that give you a chart. They give you the current PE ratio. They give you earnings estimates. They tell you all about the industry. They tell you all about the sector. So use those research reports. You can usually get them for free at the discount brokerage firm that you're working for. So now we have all of the different sources of information. Do your homework. In the next sector, we're going to talk about the different trading rules that we really need to pay attention to when we're building our portfolio. But for now, get to work, do your homework, learn as much as you can about your company, because that's how your portfolio is going to be built in a solid way.